Welcome to FinCorp 360, where finance meets clarity. Today we are breaking down one of the most important concepts in accounting, accrual accounting versus cash basis accounting. Many people assume income and cash are the same. They are not, and understanding this difference can completely change how you view a business. By the end of this video, you will clearly understand how both methods work, when to use them, and how they impact financial statements. Let's begin with the simpler method, cash accounting. Under cash accounting, revenue is recorded only when cash is received, and expenses are recorded only when cash is paid. If no cash moves, nothing is recorded. For example, if you provide consulting services in January but receive payment in February, revenue is recorded in February. This method focuses purely on cash flow. That makes it simple and easy to manage. It is popular among freelancers, small businesses, and startups. However, cash accounting does not always show the full financial picture. Now let's talk about accrual accounting. Under accrual accounting, revenue is recorded when it is earned, not when cash is received.
Expenses are recorded when they are incurred, not when they are paid.
This method follows the matching principle. The matching principle ensures expenses are recorded in the same period as the revenue they generate.
Accrual accounting is required under GAAP and IFRS for most medium and large companies.
Let's understand this with a real business example. A small business owner buys inventory, some on credit and some in cash.
I'll take these. That'll be 300 euros. Payment tomorrow. All right, tomorrow.
At the end of the day, he has 700 euros in cash. It depends on the accounting method. Under cash accounting, only received cash is recorded. The unpaid 300 euros is ignored. Inventory bought on credit is also not recorded yet.
So profit appears to be 600 euros.
But this does not show the complete performance of the business.
Under accrual accounting, all sales are recorded.
And all related costs are matched. Now profit is 800 euro. And the balance sheet shows receivables and payables. Investors rely on accrual accounting. Profit company can go bankrupt due to cash shortage. Cash flow statement is critical. Cash accounting, simple and cash focused, with a tax timing advantage but incomplete visibility. Better for decisions but more complex. The key lesson is simple.
Income and cash are not the same.
Understanding this difference makes you a smarter business owner, investor, or finance professional. Here is the truth most beginners miss. Profit is based on accounting rules. Cash is based on reality. A company can report strong profits yet struggle to pay salaries. That is the danger of confusing income with cash. Cash accounting shows you survival. Accrual accounting shows you performance. Financial intelligence is not choosing one method over the other. It is understanding how they connect. Accrual accounting tells you how well the business is doing. Cash flow tells you whether the business can continue. In part 2, we will go deeper. In part 2, we explore the real power behind accrual accounting. We will break down working capital, cash conversion cycles, and why growing companies must transition to accrual accounting. This is the difference between running a small business and managing a scalable enterprise. Cash accounting helps you count money. Accrual accounting helps you understand money. True financial mastery begins.
This is FinCorp 360, where finance becomes strategy.
If this video helped you, subscribe to FinCorp 360 and continue mastering finance.